Hi there, this is Cameron with 3D Carbon Industries, and this is my report to the board. So, on the agenda for today, we have the review of the financial and market performance during year two, my business plan, a review of that, assessing performance and strategy from year two, assessing the current market situation, and finally, some lessons learned from the whole project. So the financial performance review, first thing I'll show here is the income statement. So this shows performance Q1 to 6. You can see gross or revenues. Let's look at first in Q6, which is what I'll focus on because that is where we start to see the money. Revenues are up to 8.4 million. It comes together to gross profit of almost just under 5.6 million, and for final operating profit of $4 million in Q6. On to some other aspects of the financial performance, I wanted to showcase here was the earnings per share. You can see down at the bottom there for Q6, earnings per share we're up to $67 per share, and that's the first time that we've got into the green. All right, now to look at the balance sheet, we have here we go. Q6 total assets up to 6.2 million. Total debt and equity obviously matches that. One thing I want to point out here is the loan that I took out in Q5 for $250,000 has not been yet repaid. And so quickly wanted to show my financial ratios, how they compare from last time I pitched the investors. So after Q3 compared to now. You can see that the quick liquidity test ratio, there wasn't enough info to fill that up before, which is now up to 4.54, highest in the industry. Fixed asset turnover up from 3.81 to 3.22, highest in the industry. Total assets 0.28 to 1.34, highest in the industry. Now, looking at the leverage ratios, you'll see that I have used a little bit of debt. However, they are still my debt ratio only at 4 and 4.17 for debt to paid in capital are quite low compared to the industry. You'll see averages 17.10 for debt ratio and 23.19 for debt to paid in capital. So I've essentially achieved all this success while leveraging very little debt. Not that that's a bad thing, but I think it's something to point out. And obviously, gross profit margins increased. Net profit margin and return on assets, return on paid in capital, finally up in the positives. So quickly to go over the market performance, this is from Q6. As you'll see, Mountain, we have 35% of the market, which is a majority segment, or not majority, but we have the largest part of the segment. Recreation, 27%, which is a market leader. Speed, 41%. So again, market leader there as well. And so what that translates to is a final market share of 34%. So again, leading the market overall as well. On to the business plan highlights. So we have what I had pointed out previously was I wanted to increase fixed capacity, open all available stores and sales centers, enter the mountain bike market, and continue to advertise successfully to drive sales. So that's exactly what we tried to do. So fixed capacity, originally what I had shot for was getting it up to 88 units a day in Q6. Turns out that I actually had to get up to 96 units per day for Q6, so slightly higher than I had originally anticipated. So now store and web sales center, you can see that I've opened all 4 stores: Bangalore, Amsterdam, Rio, New York City. And then that shows Q3 there is when the Bangalore web sales center was opened, and that remained open for the next following quarters. So quickly, the mountain bike market, this was something that I wanted to enter, and I did so, I'd say, very successfully. Mountain bikes obviously were dominating the market, 35% segment there, which is a lot higher than any of the competitors. And total sales in Q6 was up to 1635, so selling a ton of mountain bikes. Advertising plan. So this is what it ended up being. You can see it starts at Q6 all the way over on the right. So this is actually considerably higher than I had mapped out originally. It's about half. I had Q6 was down to about 150,000 for that quarter. So obviously I turned that up, ramped that up much higher just to drive those sales. So the marketing strategy, you'll see, we had the best ad in speed. Top two ads actually. In recreation, we had not the best ad, but we had 2 and 3 in the bag. And then down to mountain, you'll see that we hit the top ad as well as the third ad. And we're just driving those ads through in terms of placements to wherever the most consumers are looking. So, for speed, if they're looking in the business magazines or the biking magazines, that's where we're going to be placing our ads. So the sales channel strategy. Here, what I wanted to do, sales had always been better in the stores. So that's where I invested the majority of my capital. People tend to buy bikes in store anyway because it's hard to buy them online. I did, continue to invest in the sales avenue, but you can see, the gross margin at the end of the day, I did better in the through the physical stores than in the sales center online. So looking at human resources, I've actually come in sort of below the rest of the competition here in terms of satisfaction. But it worked out for me, and productivity was good enough to meet my demand. And you can see that it's not like I'm drastically paying people worse or giving them significantly less pension or anything like that. Same goes for the sales force people as well. That was the production force earlier, but on the sales force, I'm low on satisfaction comparatively, or the lowest that is. But at the end of the day, it worked out for me, and I'm really just slightly behind industry standards. Now, so for the financial strategy, what I wanted to do was invest heavily in R&D. I wanted to have the best product and make sure that we could have the most sales as possible with that better product. I wanted to scale production in order to meet demand and also increase economies of scale, get better margins, and also just sell as many bikes as possible. I invested so much money into R&D in production that the only way that we were going to get that money back was by selling bikes. So there were a few divergence from the venture plan that I'd originally pitched. As I said, I invested more in R&D than originally planned. Originally, I had planned for about just slightly over $1 million in Q4 and 5, which that ended up being $1.5 million Q4 and $2 million, actually over $2 million in Q5. Also, the increased fixed capacity, which I meant before, I had shot for 88, but it actually got up to 96. I doubled the advertising budget because what I had originally planned for just wasn't going to cut it. Invested more into the employees, not so much their overall compensation compared to the industry standard, but I just had to hire more to keep driving those sales. I did take out a loan in Q4, $250,000, which made a lot more sense than incurring an emergency loan with super high interest rates. I did sell a lot more bikes than planned. Projected revenue was only 5.4 million for Q6. It ended up being 8.4, so much better. Things just changed along the way, and also the scaling that improved the margins. I wasn't expecting to sell $8.4 million worth of bikes, but there's actually a lot of good things that come along with that, like better margins. So taking a look at the current market situation, I kind of explained, there's a bit of a chokehold on the market right now. 40% of the overall market is dominated by 3D Carbon Industries. We get that majority share of speed, mountain, and recreation. So, we specialize in all three of those essentially. I have the highest fixed capacity compared to all the competitors. So we'll continue to outsell them as long as we continue to provide a good product and keep getting people's attention with advertising. And we also have great brand recognition. The market, they like it. They like our products. So I wanted to also just sort of to back some of those things up that I've just said, show you the balanced scorecard compared to the competitors. You can see we're dominating in every sense of the way except for HR, which I'm okay with because I know how my productivity levels are, and I'm okay with them, as well as investment in the future. We're slightly below zero, but this was the last quarter of operation, so it made sense to withdraw some of that money from research and development. And as far as lessons learned, one of the first ones was adapting to the consumer. So if I had an advertisement that the consumers did not like, I quickly checked what they did like and changed it. And same goes for the product. If there was a bike that was outperforming mine in terms of satisfaction, that was a bike that I was going to try and replicate. Also, the importance of advertising. I realized I would not have been able to sell $8 million worth of bikes without advertising heavily and doing it effectively and well. I had to be willing to take on the risk. Like I said, I did not get up into actual profits, until this last Q6. And so that sort of falls in lines with investing what I need in the business, even if it hurts the quarter's bottom line. I was happy to invest in that fixed capacity, to invest in that better carbon and better tires, things like that will appear to customers because I want to sell bikes. And of course, the ability to use financial statements as a predictor for the future. So like I did mention, I did slightly stray from some of the original plans in the business venture, or excuse me, in the venture pitch, but it worked out in the end, and I was still able to use those as a rough guide to success. So thank you very much for listening, and thanks for a great semester.